We're getting close to wrap up. I have a couple of questions for you. What have you seen that's happened? What kind of changes have been taking place in the M&A markets over the last 10 to 20 years? It's hard to believe the crisis is almost 10 years ago now, or the height of it. But
part of what's really changed in this market since I started my career 20 years ago, or even over the last 10 years, is just how much liquidity there is in the market and how cheap money is. So there is an incredible amount of liquidity that is sloshing around in the system, and what that's done is driven valuations much higher. Valuations, even though the market is sort of stalled, particularly in the Canadian context, that the enterprise value multiples for the broad equity indices are still sitting within a couple percentage points of the 10-year highs. Okay, so we have extraordinarily high valuations in the marketplace. That's driven by cheap money. There's an incredible amount of liquidity in the system. There's about a little over $500 billion US of uninvested private equity that's looking for a home. That's very different. That market has ballooned dramatically over the last 20 years, particularly over the last 10 years. And leverage markets, of course, are amplifying the buying power of that private equity capital that's out there. So if you have $500 million of equity capital, when you add a frothy credit market, you're actually getting total buying power of probably $1 trillion, of a little over $1 trillion. Let's say the average private equity deal is 55-60% debt financed. We're over $1 trillion in private equity money walking around looking for a home. So that is a huge factor. We're seeing a huge proliferation of private equity funds, and they're moving further and further down market. So private equity, we're seeing more monster private equity funds getting involved in public market deals. We're also seeing a huge proliferation of private equity funds moving down market, to the point where in the U.S., about 1/3 of mid-market companies in the U.S. are now owned by private equity funds. So there's been a dramatic transformation, and we're far behind in that in Canada. It's probably about 5% of Canadian mid-market companies that are owned by private equity funds. So watch for a change there. We should be catching up with the U.S. in that regard.
Well, and aside from the cheap money and the easy, the receptive, I should say, credit markets, we also have the large pension plans that are really getting into the private equity. Like the higher and higher percentage of their assets are devoted to private equity deals, right?
I completely agree, and that's part of when we talk about that private equity funds that are available. A lot of it is being driven by pension funds.
Yes, exactly.
That are looking for general partners to invest, make private equity investments for them. But the other thing that we're seeing is that in Canada we have some enormous pension funds, and they are competing on a global scale. When you look at even at Brookfield, also a massive asset manager on a global scale. And when you look at Canadian M&A activity last year, about in excess of 3/4 of that was actually outbound M&A activity, mostly driven, the dollar volume was mostly driven by Brookfield and the large pension funds, Canada Pension Plan, Teachers, Case, etc. So they're becoming a global factor.
That's despite a low Canadian dollar too.
And
so that really tells you something.
It's completely the opposite of what you'd expect.
Yeah.
You would not expect a Canadian domiciled investor to be making record investments abroad in U.S. dollars in an environment where the Canadian dollar is at a 10-year low. But that's exactly what we saw. And part of the reason is that a lot of their funds are actually already invested in U.S. dollars, so they weren't really invested in Canadian dollars.
But it's also a function of a lot of the other changes that you mentioned. So what do you think going forward? At some point, and people have been saying this now for 5 years, at some point interest rates have to go up. And what is that going to do to the
They didn't go up in Japan.
No. Let's hope we don't have 25 years of no growth.
Let's not have 25 years of stagnation. But I don't believe that just because rates are low that they have to come up. I don't subscribe to that. I think there's plenty of slack in the economy still, and frankly, there's so much leverage in the system right now that it's going to be very difficult, frankly, for rates to increase a whole lot. So I think we're in a slow, steady growth type of economy for the foreseeable future. I think we are running the risk of asset bubbles. We're running the risk of some severe market corrections. But a lot of that is just driven by the hyper liquidity that we see in the market. That's great for the M&A markets. I mean, generally what happens is when you see high valuations, when you see availability of capital, that is the biggest driver of M&A activity. It's the availability of financing. It's not, you don't see M&A activity go up when valuations are down. You actually see a very direct correlation between market valuations and M&A activity going up. So it's not a matter of people going out and trying to buy cheap. People want to spend when their stock's expensive. They don't really focus as much on it.
And when the borrowing component is cheap. And also from the seller's perspective, you probably don't want to sell your company when it's cheap.
That's right.
I mean, it's
That's right.
maybe
People
partly
are,
psychological.
right. People are more inclined, that's exactly right. So people are more inclined to sell it in conditions when the market's high. And we really are seeing peak cycle conditions right now.
Yep.
But we are, we're still going strong in the third longest economic expansion in U.S. history.
Yeah.
And I don't really see signs of it slowing down, or at least us heading toward any sort of a correction or another recession. You know, we still have slow, steady growth, and inflation fears seem to be tamped down. So I think what we're going to see is continued formation of capital on the private equity side. We'll see private equity become a much bigger factor, continue to become a bigger factor. I think we're going to see a lot fewer small liquid public companies. I think we're going to see them really look into private equity investment and family office investment as the way to access the capital markets rather than the traditional, I'm going to be a penny stock, a 10 million market cap company that nobody cares about. I think so. We're going to see sort of an end to all that, much of that small cap business, because it's just much easier to access private equity capital. It's much more readily available. So I think that those would be the key things. I think we're seeing in a liquidity-driven market that's going to continue for the foreseeable future. And what I'll add is that on the private market side, we are on the right, sort of entering into the early stages of an entire cohort of business owners. About 80% of business owners who are baby boomers who started hitting retirement age in 2011. So we're going to see about a $10 trillion transfer of wealth over the next 20 years. And that lined up against about $1 trillion in private equity capital when you include the leverage that's waiting on the sidelines looking for a home. So I think we will look for a lot of activity on that front.
A lot of bullish indicators.
That's right. I'm feeling good. Yeah.
That's good. I should switch.
It's a good time to be an M&A banker.
I should have went in M&A. Anyways, thanks so much for joining us today, Ferris.
Pleasure, Sean. Yeah, my pleasure.